Over the last decade, we've seen a trend of countries reprioritizing their traditional energy investment thesis in order to mitigate climate change. Russia's invasion of Ukraine is resulting in significant fossil fuel deficiencies throughout Europe and will have an impact on Asia to some degree. As the world attempts to move away from using fossil fuels, alternative energy sources are becoming more important. But in the meantime, it's difficult to close the gap on global energy deficiencies. Nuclear is making a significant comeback as an alternative green source of energy, and electric vehicles are gaining popularity as well. And with them, there's a growing demand for lithium for battery manufacturing. Joining us to talk about uranium, strategic commodities, and carbon credits is Nicolas Piquard, portfolio manager at Horizons ETFs. So stay tuned. Mike Philbrick is with me from Resolve Asset Management Global. Hit that subscribe button, give us a like, and leave comments.
The views and opinions expressed in this broadcast are those of the individual guests and do not necessarily reflect the official policy or position of AdvisorAnalyst.com or of our guests. This broadcast is meant to be for informational purposes only. Nothing discussed in this broadcast is intended to be considered as advice.
Nick, it's awesome to have you on the show again. Thank you so much for joining us.
Yeah, thanks for having me on. Happy to be back.
Nick, among other things, one of the mandates that you are on as a portfolio manager at Horizons is HURA, the Horizons Global Uranium Index ETF. What's happening in the uranium space and what's your outlook?
Well, I mean, things have really, things were already looking very good. 6 months ago in the uranium space, the spot price was recovering nicely. We spoke in September about what was happening in uranium, and everything was going in the right direction. And things have just been turbo boosted here in the past few months, driven by the conflict in Russia, which has propelled fossil fuel prices to atmospheric levels, and uranium has followed suit because uranium is a decent provider of energy and zero emission energy at that. And governments everywhere are now looking at ways to get energy independence from fossil fuels.
Yeah, and that uranium side of things too. The thing that I always remember is the always on type of power that uranium is. That is such a great base power for communities, industrial complexes, whoever's using electrons. It's a great base rate of power, unlike some of the solar or wind type powers, which are a little bit more variant in their outputs. So is there a way for us to, as a human civilization, if you will, if I'm going to go to some large S, can we bridge the gap between where we are today and zero carbon emissions without something like nuclear?
Well, I think it's just going to be very difficult. I mean, I think that, everyone talks about, wind and solar, but as you mentioned, they're not on all the time. And, I think, wind is on, kind of a third of the time. You got solar, it's on at least less than 50 just from nighttime, daytime. But with cloud cover and whatnot, it's really only on like kind of 25% of the time. So to reach zero emission, you need baseload energy. Hydro is one of the solutions. But even hydro, we're seeing all sorts of problems with hydro capacity. We saw it early. One of the things that drove the energy crisis in Europe, even before what we're seeing in Russia today, was the fact that Norway was having capacity issues with their hydro and the lack of wind in the North Sea. So we see that renewables and zero emissions, it's not going to be easy. And it looks like nuclear has to be part of that solution.
And so how is that? I'm going to reference the Overton window again, which is just the way societies go through the viewing of a particular topic and how those views change over time, and how we've gone through sort of the post-Fukushima era. Hey, 2011, little earthquake. Oh my gosh, some serious issues on the nuclear side. And sort of denuclearizing, but now it's a different set of views that we're starting to see that power source through the lens of. And I'm wondering what are your insights, whether it's on U.S. energy policy, global energy policy? What are you seeing that's continued to sort of change the viewpoint out there as you're managing, a couple of these sort of alternative commodity funds, whether it be lithium or uranium? How are you seeing the change in that zeitgeist in the moment as you're talking with investors and managing the portfolio?
Yeah, I mean, I think, on the uranium side, we've basically seen complete 180s in terms of policies from governments. And if you look at the U.S., for example, it started with Trump and the American Nuclear Infrastructure Act, which was basically a way to get more, incentivize uranium production and save existing nuclear power plants. But that, it continued with the Democrats. The Democrats have traditionally not been for nuclear, but in the latest, Biden administration, when they were elected, nuclear was part of that platform, and it has not been the case for for Democrats. That hasn't been the case in over 40 years for them to openly support nuclear. So already you're seeing a big change in their outlook there. The other one is Europe, in particular France. When Macron was elected in 5 years ago, elections coming up now, but when he was elected 5 years ago, he had basically said, he had a green environmentalist minister, and they'd basically said they're going to reduce nuclear from the existing 75% to 50% of total energy production. Still very high by most country standard, but they wanted to move away from nuclear and more into wind and solar. Well, what we've seen in the past year with everything that's going on is a total 180 on that policy. They're now saying they're going to reinvest, build up to 14 new reactors, and they're not mentioning anything about reducing uranium as part of the nuclear as part of the energy mix. Yeah. If anything, one of the things that we saw that I just read in the news on Friday was Kazatomprom, which is the Kazakhstan uranium company, state uranium company, and it's sold off from the high. It's sold off significantly since the Russian war began because it's gone down from about $50, close to $50, to almost $25, almost 50%. And mostly it's because people were afraid of the policy implications, given that Kazakhstan is a former Soviet republic. Well, just on Friday, Orano, which is the state French mining company, they had a meeting with Kazatomprom and said, we're committed to our joint venture here. We want to expand this joint venture. We want to make sure everything works, because we need this uranium, and we want to make sure that we can still work together. And on that news, the stock was up 10%. So I think that there's definitely a lot of countries who realize they need secure energy. They need nuclear has to be part of that solution, and they're making sure that they're securing that supply.
Yeah, it was also it was interesting to see also that in January, the I can't recall the name of the authorities, but it was the folks who were in charge of ESG and taxonomy, and they made a change to allow for uranium to be included in the green taxonomy in Europe, which now allows for uranium to be part of the ESG investment category as well, openly.
Yeah, and that was a big tug of war between basically France and Germany. Germany did not want it to be in the taxonomy, and France did. The other question mark was natural gas, whether it should be part of the taxonomy. The Germans wanted in there. A lot of people thought it was not the right thing to do, given it's still a fossil fuel. But as we now know, Germany is incredibly reliant on natural gas, and they kind of agreed to disagree and said, look, you can have natural gas, we can have uranium, but for nuclear. But for nuclear, this is a very, very big deal, and I'll tell you why. Because one of the big costs in nuclear energy is not really uranium. It's the cost of building the plant
Yeah.
and financing that cost, because it takes well, it should take 5 years. Recently, it's taken a lot longer than that. But hopefully they can control the timelines. But it takes a long time to build these plants, and so the cost of money, if you can borrow money cheaply, that really reduces the overall cost. So the fact that it can get into that taxonomy and get preferential investors, or get investors more easily invested and more easily financed, that could be a big, that's one of the reasons China has been able to really cheaply build a lot of their nuclear reactors over the last 10, 15 years. It's because it's all state financed at very low levels.
And I don't think people quite understand too how low a portion of the cost production of the electron that uranium is in that whole production process, going from, uranium to electrons out the other end, and how small of a cost component is. Maybe you can highlight that as well.
Yeah, well, it is a very small cost. The nuclear fuel, it only represents about 10% of the overall cost of operating a nuclear power plant, and the uranium is only a part of that nuclear fuel cost. I mean, there's all sorts of other costs involved in enriching and whatnot, in conversion and whatnot. So uranium itself is actually a relatively small part of overall cost for nuclear power plants. So they're fairly insensitive to the price. In fact, for the past 10 years, a lot of the contracts that were signed with the utilities are at much higher levels than what we had over the last few years. What we see on the screen and what is reported in the press is the short-term spot level, but that's not really what the utilities are paying. The utilities are paying long-term contract levels, which went as high as $80, in the last bull market. Finally, after 10 years, a lot of these contracts were signed 10 years ago. Then after Fukushima, none of these contracts were signed anymore, because people were thinking, well, we're not going to need nuclear anymore. Nobody's going to want that anymore. And so now, finally, utilities are realizing, uh-oh, my contracts are coming up. I got to start contracting again. And guess what? There's a shortage. And so now we're seeing some real, over the last couple of years, we saw a lot of investor demand. We saw some price coming up just based on the fact that supply got really reduced over the last couple of years. But now we're really seeing the fundamental demand come in. And I think Cameco said on their last conference call that they've seen more contracting in the first 3 months of this year than they did all of last year.
So where are we on the supply side of that equation, though, with, sort of call it a decade of underinvestment and underdevelopment of, greenfields projects, brownfields projects? Where are we on that side? So we've got the demand equation sort of coming together strong. We've got some tightness. Do we see a lot of projects? I wouldn't think we would, but where are we on the side of having more projects, producing more of the product in order to facilitate the need?
Well, that's an excellent question. And just to get back to where we need just to get rid of the supply deficit that we have right now. Just today, forget any kind of new plants coming online. Just today, we're significantly below what we need just to get back to kind of a no deficit situation. Even if you brought back, McArthur River, which is the largest mine in the world, which Cameco announced that they want to bring back, it still wouldn't get you there. You'd have to get all the other mines that have closed down, and some of them are pretty much close, aren't really going to produce any more uranium. Ranger is an example of that in Australia. That's shut down. That's no longer really going to produce any more uranium. Other mines like Langer Heinrich, for the Paladins mine, that's 4 million pounds a year. That could come back online. There's a couple here and there, but really you're going to be relying on Cameco to bring back the 20 million pounds from McArthur River. And they've said that in the process of doing that, they're only going to bring back Cigar Lake at half its capacity to extend its mine life. One of the question marks is how long are these mines going to go for? Cigar Lake was, at full capacity, was only supposed to go until the end of this decade, and after that, it was going to run out of uranium. So if you're looking at the supply-demand picture, in the short term, if you turn everything back on, you might be able to more or less kind of get there, but you wouldn't be able to get there if demand starts going up, and you wouldn't be able to get there in 10 years. So, if things are going to run out, you got to start thinking about, because these mines take a long time to develop. One of the highest grade mines in the world, in terms of discoveries, is the next gen Arrow deposit in the Athabasca Basin. It was discovered, I think, in around early last decade, 2012. They've done some work. Now they're going to make it. They're probably pretty close to making a decision on what to do in terms of getting the project started. But you're not going to get uranium out of there, out of that mine for another, I don't know, 5, 6, 7 years, maybe more. So you really got to plan ahead. In Africa, you have some projects in Africa where the environmental permitting is a little bit easier, and so you might be able to get some mines in Namibia and some mines in Niger operating, but you're going to need $60, $70, $80 uranium prices for that.
Right.
So it's the supply and demand picture is still very, very bullish in my view.
Yeah, so very tight, and one of the old adages is the solution for a tight commodity in higher prices and low supply is higher prices. Higher prices get more production online. They justify the discounted cash flow models in order to make the investments happen. And I think we're in this very weird and unique situation where we've had a whole bunch of other pressures, whether it be Fukushima, ESG, the mislabeling of ESG to some degree, create a very, very tight situation, which, is solved by higher uranium prices, which I think pretty much everyone is accommodative of at the moment, which is the nice part of it. Go ahead.
It's pretty elastic right now, right? I mean, the price can go up substantially and have little or no impact on the continued demand.
Yeah, no, and I think you mean inelastic. Like basically,
pardon me.
Basically, the price can go up, and there's not going to be an equivalent supply reaction for years. And we're even looking at some of these smaller companies. There's still a lot of they rallied initially, but they haven't really done that much since that initial rally. There's still, I believe there's still going to be a lot of M&A. I don't think this bull market is going to be over until you start seeing major miners deciding, we have to be in uranium. This is going to be part of the energy future. It's no longer, right now you look at the major uranium producers, it's just Cameco and Kazatomprom. That's all they do. You got to get more, you have Olympic Dam, and you have some uranium byproducts in Barrick's mines. But for the most part, the major miners haven't really been involved in the uranium space. And I think as they see this transition happening, they're going to be looking for projects to acquire. And that's when you're going to get some major price movements.
Nick, where do you see the price of uranium going?
If you would ask me 6 months ago, I would have said, $60, $70 where you would have gotten, in the short term. We're here now. One of the things that's changed over the last 6 months, of course, with all this inflation, is that the break-even price for all these companies in terms of, starting production, it used to be $60 last year. Now it's going to be higher than that. Right. So now, just like the price gone up, and the break-even price has gone up as well. So I think we could definitely in the short term, we could get to $70, $80, and I think eventually, we overshoot that as the demand picture becomes clearer. Right now, I think it's really been driven by the demand from investors, which we should talk about that a little bit. That's been pretty significant, but also the reality on the ground, which is, governments, like we mentioned earlier, governments everywhere are realizing we have to make sure that we secure supply, and that we this is an important thing for us, and that we support this industry. And so I think investors have reacted to that. But I think eventually, just like every bull market in any commodity, things are going to overshoot. And so I think we could easily get to over $100.
And what about we'll come back to the demand from individual investors too, because I do want to pull on that thread a little bit. But before we go there, I also want to just touch on or understand that there's a lot of talk of the sort of smaller sized modular sort of reactors that are a little bit more mobile, set up more quickly, and also use spent rods or spent fuel in order to provide some sort of fuel for the reactors. How real is that? How true is that? How close is that to a reality? Is that kind of sort of pipe dreaming, or is that a real thing?
I think that is a real thing. I think that there's projects now in the U.S., in Canada, in Europe, and depending on your definition of an SMR, a small modular reactor. They're operating in Russia and China already. The whole idea with SMRs, they're not that new or that incredibly innovative, in the sense that we've had small modular reactors we've had them in nuclear submarines for a long time. And so, they operate very well in these submarines, and so they're just, what makes them interesting and why people are starting to talk about them more is that, can we start mass producing these? Can we put them in a factory setting where, because as we talked earlier, most of the cost of building nuclear energy is in the building the plant, and that costs a lot of money. But can we reduce that cost by creating a factory-like setting where most of the costs are contained, and you can fast track the production of these things? If it takes you 10 years, if you have to borrow money for 10 years to build anything, it's going to be expensive. But if you can build the same thing, even if it's slightly more expensive, because one of the problems with SMRs is that because they're smaller, on a cost per watt basis, it ends up being more expensive because you're not maximizing the total power. But if you can reduce the timelines from 10 years to 6 months, and you can then kind of copy paste all over the place, then maybe you get to a point where it's competitive. And that, so we're not there yet, because they're still getting approvals on these. I think Canada aims to have their first SMR up and running by the end of this decade. I think the U.S. is maybe a year before that or something like that. But with NuScale, I think the Ontario government is working with, I think, Saskatchewan and New Brunswick. They had an agreement on working with the SMRs. So there's a lot of policy, and a lot of governments are looking at SMR because they're safer. The new designs don't melt down. They can fit better within kind of a solar and wind. Like, you can just kind of pluck them in different areas. But more importantly, for a country like Canada, you could put an SMR in a mine in anywhere in northern Quebec or northern Saskatchewan or wherever, where it's very hard to get electricity and very hard to get a grid. And you could use that instead of diesel, which is actually a lot more expensive than most electricity generation. So there's a lot of application. I think we'll see those applications come potentially out first, where on islands where electricity is expensive, or in other places where electricity is expensive.
So Nick, in all this, there sounds like there's a huge opportunity for a high-end labor force as well. Can you expand on what are the implications for employment growth in this, or in this type of industry versus other energy industries?
Yeah, well, I think we can joke about it, but like if you look at Homer Simpson's job, right, and at the power plant, it's technical, high-paying job, which the all these countries that have nuclear are kind of increasingly short of, and nuclear, or EDF, which is the French electricity company, is actually the third largest employer in France. And part of that reason is because these power plants, one of the reasons they're expensive is because they do require a lot of labor to maintain, and highly trained technical labor, which is fairly highly paid to keep these running. And so for governments, relative to solar and wind, which kind of, once you install it, it kind of, it's a little less labor intensive. So this is kind of a good solution for employment as well. And when these nuclear power plants shut down in the U.S., I mean, that was one of the big things with the Bruce power plant in Illinois. It's the largest power plant in the U.S. It was one of the best safety records in the U.S. They had a very highly trained they have a very highly trained labor force, and they looked like they were all going to be out of a job by this year, unless the government helped them. And so the government of Illinois basically said, we got to do something. This is zero emission energy, of which we don't have very much in Illinois, and this is the biggest power plant in the U.S. And we have all this job. If the Bruce power plant shuts down, that entire town, basically it ends up like a Flint, Michigan. And so, governments don't want that. They're under a lot of pressure to make sure that that doesn't happen to these towns and to these cities. And so, and now they can also say it's going to help get to, zero emission, and you're going to save these high-paying jobs that pay, a lot more than minimum wage. And so, I think from that perspective, it's an often overlooked, I think, argument.
Right.
But when the nuclear power plant is in your constituency, that's something you're very aware of for sure.
Yeah, and I can start to see how the puzzle pieces are sort of coming together as you go through tightness in the supply-demand dynamics, the urgency for more green energy, and the coincident need for whether it's build better, build back better, infrastructure plays that are long-term in nature that are going to create some sort of sovereign safety around the source of the energy power, the energy as well. So it really feels like this mosaic is coming together. And and just to add to what you're saying, Mike, is when you consider what the environmental toll has been as a result of shale and in the Permian, that environmental toll has been huge in terms of people complaining about gas coming out of the ground and Yeah, and then you've got all the ramifications of the oil sands. If you want to talk about environmental degradation,
there's that too.
For hydrocarbons and whatnot. And maybe we can just now, if you don't mind, can we circle back to that demand from the individual investors coming on board, maybe, and highlighting a little bit more? Let's pull on that thread. So what are you seeing just generally? So this initial thrust in demand has been largely driven by investors?
Yeah, investors who, so about 6 months ago, I think in August, the Sprott took over the Uranium Participation Fund unit, which was basically a fund that invested in uranium. It got started in 2005, during the previous kind of bull market in uranium, and initially, it did well, and of course with the sell-off in prices in uranium, it kind of was lagged. And kind of a bit of a laggard for the better part of last decade, and things started to pick up again a little bit, and Sprott really saw an opportunity to They saw an opportunity in uranium. They've also actually acquired an ETF in the U.S. that tracks uranium stocks. And so they've become very bullish on uranium, and they decided that the Sprott Physical Trust was a good way to play that. And the demand, credit to them, they've been able to generate a lot of interest in the sector, and they've bought, I think I got to look at the exact numbers, but they bought tens of millions of pounds of uranium, more than the largest mines produce, in a year, and it's been relative to the size of the original fund. The original fund was $600 million. It's now up to $2.5 billion, and that they've done that in 6 months. And so I think what's happening here is what's really kept the price low in uranium for a long time was the excess inventory that had built up over the years. So what happened with Fukushima, of course, is Japan shut down all their plants. China put their plans on hold for years, and Germany shut down a good portion of their plants. And so you had all this supply that was going into these utilities that didn't need them anymore. And so those utilities, they have all this extra uranium, and they kind of piled up, and they said, well, we got to start selling it. And so over the years, they're slowly selling it, but there's no real buyers in the short-term spot market. So, they've basically just been, slowly selling and keeping the price low. And nobody knows exactly how much of a secondary inventory exactly is out there, because a lot of that inventory is earmarked for future electricity generation. So it's hard to dissociate, well, how much inventory is really available versus how much is there but required. But I think we're about to find out.
Yeah,
because
there's the stock and there's the flow, and we're using up the stock, and now the flow's getting a little tight too. So the stock flow is a little off, but
exactly
that is that's really interesting.
We've talked about the price, the outlook for the commodity, and the supply-demand factors. What about the companies in the sector that are part of the index that
well, can we just before we go to the companies, and I think that's a great next place, I also wanted to just highlight how uranium is unique in the commodity space, in that it's not really there's not a highly liquid futures market for uranium, right? This is pretty serious product that one needs to be highly regulated to handle. And so I wonder if you could just, before we go to the companies, let's just one last point on uranium and why it's such a unique asset class, and why funds both that are managed at Horizons, like Hurrah, and I know you have a portion of that is actual commodity underlying as well as the stock. So you've got a nice mix of those things. So if you're an investor, you can kind of buy it all in one spot. But maybe highlight the sort of the unique nature of the uranium commodity market before we go to the companies.
Yeah, no, I mean, uranium is really unique in the sense that, well, first of all, as you say, there's no futures market, so there's really no way for speculators to really make markets in it. And so what ends up happening, and these cycles are very, very long-term cycles, in the sense that most of the buying and selling happens for long-term contracts. So there's not that much discovery in the short-term market, and because there's not that many participants, there's that much price discovery in the short-term market. Prices can really move a lot more on the short end than they would otherwise if there was a liquid, market. And the other thing is it's a very long cycle in terms of the bull markets and the bear markets. If you look at oil, or if you look at natural gas, it's relatively easy to increase production if the price moves up. So, I mean, right now we're in a very distinct situation. But for the most part, if the price of oil goes up, you can start producing more oil, drill more oil. There's the lag is not huge in terms of getting more production out there. But with uranium, you make a decision to build a uranium mine, that takes a long time. Getting it to production, everything takes a long time. It takes 10 years to get that project up and going, sometimes more. And similarly, so that's the supply side. That takes a long time. And similarly, on the demand side, it's very long, cycles. With nuclear power plants, just building them takes 5 to 10 years, and then once it's up and running for 40, 50, now 60, 70 years. So these are very, very long dated cycles, and so it ends up being when bull markets, they get really, really high, and then they get, and then you get very, very low bear markets. And so we had this bear market that lasted for 8 years or 9 years, and I think we're still at the beginning of a long bull market.
Now over to you, Pierre, for the
the companies.
I don't know if you had any specific. I don't know if you had any specific company.
Well,
questions.
There's the two largest producers, Cameco and Kazatomprom, and I think you talked about Kazatomprom in the beginning about how the stock price was down 50% because of the reaction to the policy threat, because Kazakhstan is a former Russian republic, and then how that sort of turned into an opportunity for investors getting at those levels because of the change in sentiment.
Yeah, no, so absolutely. And I think, Kazatomprom at these levels, these price levels relative to where the price of uranium is, they are the low cost producer. And with uranium at $60, if you're buying at Kazatomprom today at this price, you're pricing in a lot of political risk. I think that if it wasn't for the political risk, the price would be a lot higher. And so I think that if you feel comfortable with that risk, then it's certainly, it seems to me that it's certainly an opportunity. And if I look at the HURA ETF, the only reason it's not at new highs today relative to where it was in November is because the Kazatomprom price has come down so much. You look at Cameco, it's at new highs. You look at the uranium price, it's at new highs. But I think there's also some opportunities in some of the smaller names. The smaller names, they initially did extremely well on the initial, and then they've kind of settled down a little bit. And I wouldn't be surprised to if uranium prices keep going the way they are, they're gonna play some catch up. One of the tricky part with uranium companies, of course, is right now there's really only a handful of companies that are actually producing uranium,
right.
and so for a lot of these other companies, there is some risk in terms of building the mine and producing, and there's all these risks associated with going through that process. And that's why I always kind of advocate for a diversified portfolio approach, where you're buying a lot of these different companies and projects, and so that if one doesn't work out, you're still benefiting from all the ones that do.
The other thing that I'm reminded of as you talk about Kazatomprom is the the deep water Horizon debacle that occurred, where BP was marked down an awful lot because of all the potential risks, and the choice you have. There's risks. If you're going to go and find a bunch of junior producers that are looking for projects, trying to develop them, get them to production, that's a whole set of other risks. There's
Sure.
regulatory risk in there. With Kazatomprom, you don't have those risks. You have political risk, but
Yeah.
you know that the commodity is there. You know it can be produced. You know it can be delivered. So it's just a slightly different set of risks that, I think would be quite complementary in a portfolio. I like you, would opt to have both. If you go back and look at BP, it was steeply discounted and then recovered through time. And again, there's risks everywhere, and you have to, factor in the risks you want to take. And if it's a political risk in there, is an interesting one to consider, especially given the current valuation. It's kind of an interesting paradigm where if everyone's running out of the theater because someone's yelled fire, you might want to pick up a ticket or two. I don't know.
Exactly, and a lot of investors have really said, okay, well, I'm just going to buy, a Cameco because it's the biggest one, and it's in Canada, and it's fairly liquid. So for bigger investors, they might just think, well, the liquidity's there. But the fact of the matter is, you look at the uranium space today, and a lot of these investments are becoming more and more liquid. There's more and more liquidity now in the Sprott Trust. There's more liquidity in the ETFs than there was before, and Cameco is a great company. I think they'll do great. But if you look at their two biggest assets, you have Cigar Lake, which is probably going to run out, in the next 10, 15 years. And then you have McArthur River, which, that's kind of their, flagship operation, but it's a complicated mine, and they shut it down 4 years ago because the market was bad, but also because it's a tough mine, and they're gonna have to restart that. That's not a zero risk, event, and I wouldn't be surprised if Cameco has to go in, or if Cameco wants to acquire other companies and say, now that our stock price has done so well, why wouldn't I go and use my paper to secure more supply down the road? So I think we're going to see some activity.
Yeah,
in the space.
I think you nailed it in that. Why? So you've outlined the two mines that Cameco has. If you buy one company, you got those two mines, and you got one set of risks. To me, it makes a lot more sense to diversify that across a suite of exposures, both small cap, large cap, and some of the commodity, which is why, I think the Hurrah ETF is particularly novel in that approach, in that it has taken a sort of a very well diversified approach, so that the investor knows, well, I mean, if Kazatomprom or if a company has trouble, my whole portfolio isn't in the dumpster fire. Which, by the way, all of those arguments about Cameco you could make for Kazatomprom, other than, okay, the jurisdiction is a little bit dodgy, but it is, lowest cost producer, and on and on and on. So it's hard to ignore that. And then you throw in, hey, by the way, we just put it on sale. Okay, well, again, diversity through your portfolio is a benefit often.
Yeah. So Nick, apart from you mentioned that a lot of there's a lot of state sponsorship of development of nuclear. What do you see happening in capital markets in terms of money being raised for private sector endeavors around uranium? You mentioned Sprott. You mentioned some of the activity that sort of triggered the rise in the price of the commodity this last year. But what kind of activity are you seeing in terms of investment banking?
Yeah, I mean, I think there's obviously more activity now that the prices have recovered, and the junior miners, they're always going to be looking for capital just to forward their projects, and so we're seeing some of that. But what I haven't seen as much as I thought is a lot of M&A activity in terms of companies tying up, or some consolidation of projects and whatnot to create like bigger, more diversified companies and whatnot. There's been a few things here and there, but I think that's a sign that we're not really in the thickest part of the bull market yet. We see the regular kind of money raises from the juniors to kind of forward, like I need $5 million to kind of do a PFS or something like that. Mm-hmm. But we haven't really seen big deals or big M&A activity yet. And I think that's likely coming though.
So altogether, very positive fundamentals.
Absolutely. And I think one of the reasons that we haven't seen, a lot of that is because, people don't want to sell yet. Like if you have a good project that you're slowly bringing to production, why would you want to sell? Right now the outlook looks very, very good. You're going to want to keep most of that upside. Once the M&A activity starts in earnest and you're starting to see a lot of companies sell, that's maybe when you want to start to be a little bit more concerned.
I was wondering if we'd switch gears to another commodity that doesn't have a futures contract underlying it, where investors can get access as well. So I didn't know.
Let's talk about lithium.
Yeah, that's it. So we got all kinds of alternative. This should be the alternative energy show today. But yeah, let's talk about lithium, Nick.
Yeah, I think lithium is interesting because it's an amazing demand story. You look at the demand on lithium and how it's really started to grow exponentially, I guess, in the last couple of years, and it always was going to be that way, but I don't think the market really woke up to it until recently, and you've seen price of lithium carbonate go from up fivefold, in the past kind of 8 months or so, and it's whereas battery prices had been going down for consistently since 2012, basically down almost 80-90% on a dollars per kind of kilowatt hour basis. That finally was up this year because of the price of lithium, and the high prices of carbon, the high prices of oil in particular, and gasoline. The big thing is, of course, the price of gasoline in the United States, where they're used to getting really cheap gasoline, and it's only going to increase the speed at which people will be converting to EVs, and what that entails in terms of demand for lithium.
And lithium's, again, not another one of those very unique commodities where there isn't an easy way to get access, right? There isn't a futures market. There's not that type of stuff. So how have you guys thought about that in structuring the ETF that you're running, and how do you approach that?
Yeah, and it's interesting because the lithium ETF, in a lot of ways, as a commodity, like you mentioned, it looks like the uranium ETF. It's a market where there's not that many big companies, that are pure plays on lithium, and there is a very there's no futures market. There's kind of an illiquid spot market, but most of the activity happens in the long dated contracts between battery manufacturers and between the miners. And I would have ideally set up the lithium the exact same way as they did, as we did HURA, which is some spot exposure through kind of a company that owns lithium and the stocks. Unfortunately, we don't have any companies that that do that, and so basically the ETF just focuses on the lithium miners. But one of the things that we didn't want to do is have something that's too integrated. We didn't want to have the battery manufacturers in there. We didn't want to have the EV companies in there. We really just wanted to focus on the commodity itself, so that it's a commodity-related ETF. It's not a
Right.
bet on electric vehicles. It's really just a bet on the commodity, because high lithium prices might mean that battery manufacturers get squeezed. Because on the one hand, EV companies, they're going to say, well, we're not going to pay more for this battery. We need to stick to our sticker price of $50,000 for this car, and so we're going to force you to take the costs. And so I could see a scenario where the battery guys kind of get squeezed a little, and we already see that from Tesla. Tesla's already basically said, we gotta vertically integrate this, because we don't want to be on the hook for these fluctuations in lithium prices. So I wouldn't be surprised if they made a big acquisition of some lithium deposits and try to vertically integrate themselves so that they're sheltering themselves from the volatility in the lithium price. But in the short term, there's just not enough lithium being produced today.
As you were saying that, I thought that exact thing. What a great hedge to your Tesla position, or what input auto manufacturer name here. in that you're going to buy a suite of these producers of this very highly desirable product. So we've got the demand side, obviously, kind of exploding. We've already seen a 5x on the lithium price. What's the supply side looking like? So you mentioned there's just not enough being produced. What's the gap like, and what do we see in projects coming on board and investments in that area? It's a little bit different than uranium, in that uranium was going through this sort of cloud of Fukushima period, where lithium's been a little bit more in the sunlight for a number of years. So, but how is that differentiated on the supply side, or has it?
Yeah, I mean, it has been, and so I think there's been potentially more projects, more investment in lithium. But I think for the most part, industry thought that it would be slower. The demand curve would grow slower, and so even though there's lots of projects and lots of lithium being produced, it's not growing fast enough relative to where the demand is growing from. So most of the lithium reserves are in Latin America. They're in Argentina, Chile, and Bolivia, in their salt flats where you can get lithium brine extracted. Albemarle, SQM, they all have they're the biggest lithium producers. They all have projects in that area. But I think we're going to see the biggest growth, and because I think that's one of the where the Chinese are really getting involved as well, is in Australia and the spodumene lithium deposits, because that's in a way that's more conventional mining. It's open pit, you scoop it up. It's the lithium's in a rock as opposed to in a brine, and so a lot of these big projects are coming online, from that perspective. So there's there, but what we saw recently is more and more recently, a big company out of Australia, IGO, took a 50% stake in a big lithium mine, the Greenbush mine in Australia. Realizing, what, this is mining. This is something we know. We mine other metals. We mine cobalt. We mine nickel. We know we these are battery metals that we want to be involved with. And so it just makes sense for us to add that as part of our portfolio, and whereas I think the lithium brine projects, that's been more specific to companies that kind of specialize perhaps in that. And so we've seen Albemarle, we've seen SQM. These are companies that don't that really focus on lithium. But now we're seeing some bigger mining companies getting involved in these spodumene projects.
And so where are we with valuations? Sort of that sector has had a bit of a pullback in the last sort of, call it 6 months or so, maybe 4 or 5 months. And yeah. So where are we at with valuations? Where were we at? Where are we now? How do you see them growing into those valuations, if that's the case? Or what are your thoughts there?
Well, what's interesting is that even though we've seen the lithium prices basically, as like I said, even though they're up 5 times on the short-term price, what's a little less clear is what that's going to mean for the long-term price. But certainly the stock prices haven't really reacted that much to this huge boost in prices. They're up, but they're not up like they would be if people were pricing in the current lithium prices, in a kind of an NPV model. So there's a couple reasons. I mean, obviously, there's a lot of lithium, and so in the world, and so maybe it's just a matter of funding these projects and getting them out of the ground, and people think that maybe the price will come down. And there's also a little bit of political risk, which is something that you got to maybe worry about. In Chile right now, they're kind of rewriting the constitution. They had these, they had the new president of Chile used to be kind of a student firebrand. I mean, there's always some fear mongering going on. I mean, they said that about Lula when he got elected in Brazil, and it turned out, everyone thought he was going to be the next Chavez, and it turns out that he governed in a much more left of center type, government, and Brazil's economy and stock market did fine. But there is some risk with Chile that, they say that they want to potentially nationalize copper and lithium mines, and they're one of the largest lithium producers. So and that's why, again, you kind of want to have that diversified approach where, you're not taking risk on just one jurisdiction or one company. But more than the supply, I think more supply will come online. But I think, whereas I think uranium is both a supply and a demand story, I think lithium is really a demand story. I mean, I think the demand could just really explode. I mean, next year, according to Bloomberg research, the outlook for next year is to sell 10.5 million vehicles, electric vehicles for next year, which is 50% more than what was sold in 2021, and I think 3 times more than what we had in 2019. So that's huge growth. But 10.5 million versus the number of vehicles in the world today, I mean, that's nothing. That's a drop in the bucket. And even with just that growth, the market is already buckling. It already can't handle that kind of demand. The Chinese are running around trying to secure supply by buying projects and getting involved wherever they can to secure supply, and we're at 10.5 million. So what happens when we get to 20, 30 million? I mean,
100 million.
That's next.
Yeah,
that's
100
the
million. I
year.
mean, these numbers are big. Yeah.
Yeah.
Well,
That's
they're
2024.
Yeah, well, and they're big numbers, but they're small in the context of the overall car market. I mean, they're minuscule still.
That's what I mean. Yeah, it's still only, like, I think in China, which is the biggest market in terms of EVs, in terms of EV penetration, I think it's up to close to. I got to check my numbers, but it's somewhere between 10 and 20%. I'm being fairly wide here, but if you look at the United States, it's only 3.5%. It's less than 5%. That means that's a lot of cars.
Sure. If we're all driving EVs in 2030,
I'm driving one now.
There's one car for every man, woman, and child in the U.S., right? Or
I'll be jealous every time I go fill up at the tank. I'll be thinking about you, who's basically fueling up for nothing.
I will say my personal experience is that once you do drive an electric car, you will have trouble going back to a petrol engine, other than the sound, the nice roary sound that you could get from a nice sports car or whatever. But it is an interesting set of scenarios there where you get in it. It's a better drive. I mean, if you want to go for an 8-hour drive, maybe not, but.
Yeah, no,
well,
absolutely.
Then you have to stop somewhere and take a half hour, 45-minute break, right?
Yeah, get a charge up. But everyone will, again, as the acceptance rate increases, that's going to be just a normal thing, or the range will get longer, and certain folks will be opting into whatever range they want, paying more or less for that in their vehicle.
Well, one of the other things that because we mentioned the demand side, and one of the things we talked about with uranium was the political support. I mean, the political support for EVs is more unanimous than it is, for nuclear. And nuclear is still a little bit divisive. I think people are coming along, but it's still not unanimous. Whereas EVs is becoming close to unanimous as you're going to get on any political debate. And the number of countries that have set hard targets from between 2030 and 2040 or 2050 in terms of saying we are no longer going to allow the sale of internal combustion engines after this date means that there's a very distinct timeline by which you have to get all this lithium out of the ground. And that's one thing that politicians don't necessarily think about is the process by which the market is going to allow for that kind of growth.
Love it. Is there anything that we've forgotten to ask you about lithium?
No, I think we did a pretty good job of covering it. I think I think lithium is really a huge demand story. The one thing, just to put it in order of magnitude, I always like to for the last kind of 25 years, we've gotten pretty used to, portable computers and laptops and smartphones. And so we all know lithium. We all have lithium batteries around us. We know how useful they are. But if you look, lithium demand has been growing for a long time. But if you compare the order of magnitude, a laptop uses 8 lithium cell batteries. An average EV uses 5,000. That's just the order of magnitude we're looking at. I mean, everyone has a car and a portable computer, but that car is going to require a lot more lithium.
Well, that's the story, right? The story is that, I like your point, Nick, is that this story is unfolding right in front of our eyes. We're so but maybe we're taking it for granted a little bit, or we don't understand the fundamentals of the lithium market. But it's an amazing story. To forego it because of a misunderstanding would be terrible.
Yeah, it's going to be, I think, one of the huge trends of our lifetime. Just like the adoption of internal combustion engines was the first time around.
Yeah, the adoption of the laptop portable computer, right? In the lithium use. Now I wonder if so we've talked about two kind of very interesting alternative energy plays that are a little bit different, very early, don't have sort of fully developed commodity markets and things like that. And getting into that, how are you seeing the response from the sort of ESG front on the topic of mining? Because at the end of the day, both of these products are mined. Mining is particularly dirty. It's particularly environmentally impactful. We talked about a number of jurisdictions that have varying degrees of social governance when it comes to human rights. So how is the sort of the investment world grappling with, hey, we need these products to get green, but they're kind of dirty? And what are you seeing? Is there any movement towards, being more particular about where you're sourcing your product from, or from the companies that it's coming from, or a higher level of ESG accountability for those mining corporations? Are you seeing that more on a grand scale? And how's that impacting things?
Well, I mean, on the corporate side of things, certainly all the companies involved in lithium and in particular, and uranium as well, they're all very focused on the impact of reducing the carbon footprint and what their product can do to help that. And every company today, it's been incredible to see how focused companies today, and all the mining companies are focused on ESG and showing what they're doing to improve environment, social, and governance, for what they do. On the investor side, it's a bit of a different story, and I think it kind of depends. Some investors kind of understand that lithium, in particular, has to be part of EVs, and there's if it's not lithium, it's going to be some other metal or some other, you got to take that, you got to mine that stuff somehow. So I think there is a realization, and so that is certainly on the radar. I'm not sure that translates into that much more investor demand, but it's certainly they would be aware of that. On the uranium side, it's still a very divisive thing because and we have an ETF focused on ESG, and the index provider, the index that we follow that focuses on ESG metrics. One of the things that they say is that they will not invest in uranium because uranium is used for energy, but it's also used for weapons. And so they feel like that doesn't meet kind of an ethical standard. So it's a very divisive issue. I don't think there's any consensus see it as part of the transition, and some of them do not. But I think what we are seeing is the decision makers, the people who realize, when the wind's not blowing in the North Sea and the hydro dams run dry in Norway, there is no energy anymore. So those are the guys who kind of say, well, this has to be part of the solution. But in terms of the ESG investors, I think it's still a very split crowd there.
Yeah, it's a sticky wicket. I know it's a very difficult question, and to some degree, when you're looking at through the lens of ESG, and in this case, sort of environmental is what we're focusing on to some degree when we're talking about mining. There's the corporate structure, but environmental stewardship and those types of things. I wonder if we're going to see further costs built back into reparations of mines, or we're going to start to see, and that's to say that if you would like to improve sort of the environmental side of the governance, one way to do it is to say, okay, well, we're just not going to invest into any of these whatever quotation dirty companies. At the same time, you can make a massive amount of impact improving those that have been the worst offenders, right, in the past, or improving their ability to understand the impact they're having on the economy, and then billing that back through the commodity value chain. Because if it's in fact we want to repair these, mining sites, well, that has to be a cost that's built in to the commodity itself in order to feed back to the mining company in order to make these reparations. And that means higher costs to end users of these products that have these commodities embedded in them. It's just I think, probably a little early on the question, but I think we're going to start to see more and more of that as we see the crisis necessity change of, well, we have to do it. And then saying, okay, well, now how do we live with ourselves? How are we going to start to deal with the environmental impact of what we feel we have to do in order to have less oil being pumped, as it were?
And that's a great segue to change gears again and talk about the carbon credit opportunity.
Yeah,
hey.
Great.
Right.
Wow, We're killing it. We're killing it.
So, Nick, what's going on with carbon credits? Before we jump into that, I just had to bring up again. Did either one of you see the movie Anthropocene?
No, I have not. Is it good?
It's as you were talking about, it's great. There's this whole sequence about Germany in there about how they're ripping up the countryside for coal because they abandoned their nuclear. They shuttered their nuclear facilities. Yeah. But what I thought was ironic, you mentioned how big of an employer nuclear power is in France and how much nuclear power there is in France, and then so. What was ironic in all of that was, again, that while Germany shuttered its nuclear facilities, half of them, they also this year decided not to shutter the remaining half, and they're stuck now with having to continue to buy gas from Russia, and because of their shortfall, they have to buy nuclear power from France as well. So they're kind of caught between these two powers. They're caught, on one side they've got France selling them nuclear. On the other side they've got Russia in the middle of this war that we're in now, selling, having to be at Russia's mercy to buy gas and hoping that Russia doesn't turn off the
tap.
The tap, yeah. And yet they're still squabbling over nuclear. They're still squabbling over taxonomy. They're still squabbling over this stuff, and then if you come to the carbon credit situation, they're not taking that seriously either, right? I mean, we had a conversation with Hugh Hendry not too long ago, and he brought up the fact that BASF doesn't care about the carbon permit system in Europe until those carbon permits are 120 euros or 130 euros, right? And they're largely ignoring the not the opportunity, but the use of those carbon permits. They're not taking it very seriously. But so I wanted to say that was my roundabout way of segueing into the carbon permit system and the opportunity that's there for investors to participate. To that's actually a real opportunity for investors who want to align their portfolios with ESG in a very direct fashion. The carbon permit system does allow for that.
And the European carbon market is probably the most liquid and most developed carbon market in the world today. I mean, there's still, there's other systems in California and a few other jurisdictions, but Europe has kind of really led the way on the European, on formalizing kind of a market for it, and the price of carbon has gone up substantially, in the past year, along with everything else. One of the side notes I would add on the whole Germany situation that you were talking about earlier is that on top of having to mine more coal because they shut down their nuclear power plants, they also spent a vast amount of money on their energy wind initiative that was supposed to kind of basically make up for the loss of nuclear in terms of emissions. And after something like 8 years and billions and hundreds of billions, I think, of money spent, they have very little to show for it in terms of reduced emissions, and basically still have double the emissions that we have that they have in France, which has very little wind or solar, and it's most of their zero emissions are coming from from nuclear.
Yeah.
So but even that won't change their mind. I mean, I think it's kind of ingrained in the German psyche to be against nuclear. I don't really. There is some signs of that changing, but for the most part, they've been steadfast. It started in the 70s when they were, they didn't like the nuclear war prospect with East Germany, which was their neighbor, and it continued with Chernobyl, and it really, after that, they never really were able to come around. But in terms of the price of carbon has gone up, I think something like 3 times, in the past year, and really it's just been tracking the price of natural gas in Europe. Because what ends up happening, is to reduce your carbon emissions, effectively, you reduce your coal consumption and you burn natural gas instead, and that reduces your emissions by 40 to 50%. And so, but once your natural gas price goes up too high, then it becomes profitable to buy coal and then buy the offsetting carbon credit, and then burn coal instead. And so as natural gas prices have gone up because the demand has gone up, and now of course has gone completely parabolic because of what's happening in Russia, effectively it's just cheaper to buy coal and buy your carbon credit. And so that's kind of what's happening in the market, and it kind of puts a floor on those carbon credit prices because there's not much more. There's no more natural gas coming, and there's still growing demand for energy, and Germany is in a bit of a tight spot. We've seen a lot of volatility in the carbon credit market recently, most obviously because of the volatility in natural gas prices, but also because now this energy crisis has become a huge political problem for all governments. They're out handing $100 checks to everyone so they can fill up their tank. It's become a real problem. People can't afford to live anymore because energy goes into everything. It goes into food. It goes into your production of any good. It goes into transportation. It goes into and obviously goes into your daily living of moving around. And so the cost of living has gone up massively everywhere in the world, but in particular in Europe, because the price of electricity has been so high. And now they're like, well, maybe we got to do the opposite. Maybe we got to rearrange these carbon credits to make it cheaper so that we can get cheaper energy. So they're and that's causing excess volatility in the market as well, because now like investors are looking, oh well, what if the government's decided, you know what, we're just going to hand more credits, we're going to increase the supply of these credits, and go the other way, because we're worried about high prices, which of course is the exact opposite thing that they should be doing, because these high prices are really incentivizing the move to renewable, clean energy.
Yeah, they're trading actual carbon for paper carbon.
Exactly.
Yeah.
Exactly. Yeah. So I think long term, level heads will prevail, and the price, because one of the interesting things about carbon credits is the whole way by which they would work is over time you would reduce the amount of credits available, so that effectively you emit less and less carbon over time, right, to eventually get to net zero, which it's almost like even better than Bitcoin. Forget stable supply, you're going to have shrinking supply. It's going to be like potentially a Bitcoin on steroids. But there is political risk, because just like Bitcoin, you just create another coin. Or you could just branch out and build your own Bitcoin Cash, or just kind of do and so so that's one of the, there's a lot, it's a fairly new market. I think investors are still kind of getting used to the idea, but certainly an asset class that potentially is fairly uncorrelated to other assets. Although from the looks of it, still kind of energy dependent.
Given that, how has Horizons has structured the carbon credit ETF in order to facilitate participation for investors, and what are the top sort of 2 or 3 questions you're getting or fielding from investors?
Yeah, so I mean, I think when we first started looking at this carbon credit idea for an ETF, we started thinking, we should have like maybe buy the credits themselves, or figure out a way to structure it. And then at the end of the day, we just a lot of our products at Horizons are futures based, and we thought this is the cleanest and most effective way to do it right now, is to just have a futures based ETF. And so what the ETF does, it just buys the European market, the European futures market, and uses that futures market to gain exposure to the carbon market. That doesn't mean that over time, if more markets become liquid and that become more investable, perhaps at some point, you could expand to get into more markets. But I mean, for now, the European market is really the most liquid, and really with an excellent opportunity, because the Europeans are quite committed. You look at the green taxonomy, you look at all the work that they've done to get this market up and going. And what's nice about Europe, which is also the reason it's not great to be in Europe, is extremely hard to do stuff. Like, you got to get all the governments to agree. They all have veto powers. I mean, it's almost impossible to do anything. But once you agree, it's almost impossible to undo it. So once it gets past the finish line, it's very hard to undo. That's one of the reasons why once the green taxonomy with the nuclear as one of the alternative energies that's included in it, that was very hard to get through the finish line. But now that it's made it, it's going to be very hard for it not to go forward.
Right.
And so that's same thing with the carbon credit markets. I think it's going to be, now that they've agreed on a system, nobody wants to go back and renegotiate with like all the different countries and say, are we going to do this? Are we going to do that? So I think that's a very, whereas other jurisdictions, maybe if there's a change in government, just saying, well, we don't like it. What if, what if Trump comes and he's like, I don't like these carbon emission initiatives. I'm just going to go the other way, right? Like you're at the mercy of one administration.
Right.
With Europe, you have all these countries that agreed, and they all have to disagree, agree to disagree, or agree to undo.
Agree to disagree in the same way to undo.
Exactly.
If you thought it was hard to agree on something, wait till you agree that you made a mistake or want to modify it. I don't know what it is anyway.
But you have this decision by committee, basically.
Yeah. And so I think that this market is going to stay. And I think they're going to let the market price carbon and I mean, as a proponent of free markets, I think that's a great way to do it.
Yeah, and it's a great way for companies to, I guess, commit to and have a way to arb their exposure in that area, right? If they're producing whatever carbon or offsets and things like that, then it's a way for the market to put a price on what that is and for that to be factored into the cost of production.
Yeah, exactly. And I'm not sure how quickly or how the penalties and whatnot. I'm not entirely sure how they're going to fully be able to implement that. You mentioned BASF, not being too careful there. I think that as time goes by, this is going to be becoming more and more, relevant. And companies don't want to. These days, companies don't want a black eye on ESG matters. I'm always kind of surprised. Well, I'm not surprised, but I'm always kind of interested to seeing, like, if you go to any company website today, I mean, ESG is the first thing you see.
Yeah.
Amazing. Well, that is quite a gamut we have run. 3
alternative assets, just ripe for investment. That's
it's like the fruits laying
long-term
on the
investment.
ground. It's
not advice. Not advice.
Beautiful.
Nick, that was awesome.
Yeah, it was awesome. Nick, where can people find you if they want to look you up and follow you and see what you're working on?
Sure. Well, they can go to our website at Horizons ETFs, and we have a blog there where we discuss some of the stuff that we've been talking about today. And so that's probably the best way. And take a look at it. We sometimes do webinars for investors and whatnot on various topics. So definitely. Keep an eye out for those as well.
Perfect.
All right.
Thank you, everyone.
Who's your favorite character, Nick, from Atlas Shrugged?
I don't even know. To be honest, I've never even read the. I'm embarrassed to say I've never read the book. So
yeah.
I always get my characters confused from the Fountainhead and when Atlas Shrugged. So I always say anyway.
No,
John Gull.
When you were when you were talking about and we'll wrap on this, but when you were talking about the political risk in Chile, it reminded me of of the part where
the Oasis,
where Francisco d'Anconia, draws all of the intelligentsia of Atlas Shrugged into investing in the Chilean copper mines. And there they are. They're all at a party together, and they get the news flash that Chile has nationalized all of their interests. Right.
Of course.
And but it's the times too, right? Look at the infrastructure that is dilapidated. The way that political power is being wielded today with Putin and so there's just so many parallels that are happening again, and from a book that was written in the 50s. So
don't they happen over and over again? I remember one of my favorite quotes from Francis D'Ancona. What is it?
Francisco d'Anconia.
D'Aconia was, if you run into a contradiction, check your premise. You will find one of them is false. I love that. I mean, it's so true. Oh, I have a contradiction. Yeah, check your premise. One of them's wrong.
Awesome.
All right.